Hello everyone, welcome to another episode. It's your boy JayFx. As promised, the mic is fixed. I got a new one and I think the sound is, a lot better right now. So let's get to business. All right. I was promising you guys a video to explain liquidity, internal range liquidity and inducements. There's a big difference between these two because a lot of people get to misunderstand the concept of liquidity. I think it's very important for you to know what an inducement is. Like, you need to understand, I don't mean what it means in forex market. Inducement in general. Inducement means like if you could check on a dictionary or something, right? A thing that persuades or leads someone into doing something. You didn't see anybody saying an inducement mean liquidity right here, do you? All right. So with this by the side, I want to explain something to you guys. The mid, I think at the middle of this class, you understand the reason why I searched for that. Okay. So secondly, this video was supposed to be for my team, but I decided to share it out to the public because a lot of people got this concept miscalculated and it's affecting the market. Okay, first of all, you need to understand the concept of liquidity. Now we know the meaning of inducement, right? It's a drive to persuade people into doing something, or a drive to persuade something into doing something. Let's understand what liquidity in forex means and how do we apply this law of inducement into the forex market. Okay, what's forex? An FX, it's a digital financial market, right? Which to us, we are the retails, which means we are liquidity to the big boys. As you all know, the big boys, the smart money and the stuff like that. So we play 80% role in the forex market. Believe it or not, we are very, very important. That's why you see these brokers are out there advertising forex and stuff like that. That's because they need us in the market because whatever the market does, it's because it's trying to mislead us into losing money. Okay, they're trying to mislead us into losing money. So whatever they do, whatever they want, they have to um mislead us first. That's creating liquidity. All right. So liquidity is misleading us into doing something else, thinking that's what they want to do. That's like creating a resistance and showing you they're about to break the resistance, and then the resistance holds. Means they just liquidated us. They just with some people just blew their accounts. Some just got stop lost, stop hunted and stuff like that. So the whole concept of forex is to liquidate the retails. Right? So you understand that. So you understand that forex is a means of, how do I put this? Let's say scamming, or is a means of liquidating. I won't say scamming, so but yeah, let's use liquidating. It's a means of extracting. It's like the government, a means of extracting money from people, right? So this who are these people now? We are the retails. Now, what makes us different from the whole concept is that we are smart money traders. Okay, we try to understand what they're doing and use our smartness to follow them up. Okay, so now this means we are no longer classified as a full retail, neither are we classified as institutional traders. We are classified as smart money traders. So we play smart with our money while trading. That's the full meaning of smart money trading. To me, I don't mean this is by the book. This is to me. All right, that's what I understand. That's why I say I'm a smart money trader, not because of the box and stuff or the lines. I say I'm a smart money trader because I play smart with my money when it comes to trading. Okay, so that's all. That's the full concept. And so now, how the forex liquidate us? Now we know the aim of forex and why forex is here, what forex is doing. So let's understand what forex actually do. Now, how do they do this? Let's say supply and demand. You guys know what supply and demand is, right? The buy to sell, the supply to the demand. If the supply is greater than the demand, then the market is about to go lower. If the demand is greater than the supply, the market is about to go higher. So let's say this is a buying market, all right? Let's say the supply let's say the demand is in control right here, and you see the market going like this. The zigzag, the higher high, lower high, higher high. So let's say this was the important high where market was supposed to reverse from. So we had a break of structure here. All right. So from this, you understand that this is a previous structure. Now, using the law of supply and demand, you guys understand that the market is either here to liquidate, is either to take out the supply or mitigate the supply zone, or take out the demand or mitigate the demand zone. So they're either, let's say, this was the price of an iPhone, all right, at $100. Okay, so the price keeps going up is because the demand of an iPhone is high. So let's say at this point it became $300. It came back to 150. It got washed and then increased back to $250. So the demand, the price of the phone is actually too high. So guys take interest off it, and the company decides to reduce the price of the whole shit. And now it comes back down into a discounted price, which is around below the previous all-time high, which was 200, but now around 150. Now, then, the guys with the money who wants to reserve it because they know everybody's going to come back for this phone later on, which and us also get to buy the phone at 150, which increases the price since the demand is now high again, back into breaking the previous all-time high, which makes that phone, um, let's say $500 now. So now this was the previous, let's say, accumulation of the price of the iPhone. All right. So this was the previous stuff before the price of the iPhone moved into $1,000. Okay. So now let's say this was the Forex market. Now we understand that for this was a scenario for an iPhone, right? The company doesn't want to go down, so they keep bringing out new iPhones to take it back up, take it higher. But since Forex is a business, and then they need us, this is where we play a big role. Now they know we don't know what the iPhone company is doing, right? We don't know their plans, we don't know what they want, or if they're going to go higher or not. So what do these guys do? These guys are the guys who move the market higher, and then move the market lower when the price is high, and then let us see the price going higher to persuade us into doing shitty stuff like this. Okay, so they create this stuff along the way to make the whole stuff look as if the next movement is going to be here. Now they broke the expectation of the company, right? I'm just using this as an illustration, okay? Don't get confused. So they broke the expectation of the company to an all-time high. So now they see that they're in a new range. So use this as a forest market. Now this is a new range. This was a break of structure, right? So they're expecting us, which are the retails, to expect a pullback probably into the discount zone of this range, and then see the market going back to create a new all-time high. But that would just mean they are just giving us money, right? So what do? Once there's a break of structure, there's a pullback into the previous range, which means a new range has been created. Now I'm no longer talking about the iPhone company. I'm talking about Forex right now. Okay, so this was the previous high and low. Oh, sorry, this was the new high of the range, and this was the low of the range. So forget about this guy right now. Forget about this guy and pay attention to this guy. If they're going to move higher to create new price, because the company is going to be successful in the future, that's because um, they need liquidity. So now, what is the liquidity they have built? Now, understanding what liquidity means um, we, they need us, they need our money to push the business higher. So they need to take us out of the market. Okay. So they know we were at the previous, retracement zone, to be the previous demand zone. All right. They know we were here. So what do? They push the price of their phone, of the iPhone, way, 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 way below our expectation, making everyone who bought the phone panic. Okay, they need us to sell our phones for them to be able to refine it and get new ones. All right, I'm using this to help you understand the structure of market here and how to, an approach of supply and demand and stuff like that. So they need to do this to make us to want to sell our iPhones, and then get the company back up, because they saw the break of structure. That means the company it's going to be successful in the future. There's every probability of this company going higher, right? But now the company needs money. So what do? They need to shoot their price way below our expectation. So, to get our mind off it, like, we need to panic. Oh shit, this company is going down, it's gonna get liquidated. They did a shitty move and then stuff like that. So what else did they do? They make a pump back up immediately. Now, this move back up is wasn't because of this impulse move that was created. This is where people get this all wrong. They think that these guys are moving back up real fast because they did this liquidating real fast. No, they're doing this to get um early buyers into the market. Okay, there are guys who are actually there are retailers who are actually watching this price. They need to see this liquidity get liquidated. That's the smart money traders now. They know that this is liquidity. All right. So these guys do this. Now the intentions of doing this are not because they will want to go higher, because they know the smart money traders are waiting for them right here. They know the smart money traders are waiting for them to take out the retailers, which was the trend line. So they know that we were here expecting them to pull back up, right? Because this should be the other block that broke structure. Okay, so this was the liquidity, and then they're moving back up. So they brought the early guys into the market right now. All right, they took out the liquidity and brought the early guys into the market. But there was something that I did not understand. The previous price, which was within this range, hasn't been cleared out completely. The previous liquidity. So once a range is broken, everything within that range becomes liquidity. That's why we have two types of liquidity: the internal range liquidity and the external range liquidity. Now, once this range is broken, everything within this range, everything within this box becomes liquidity. Sorry, every low within this box it becomes a target. All right. So now this high, is a weak high. So it's the external liquidity because it's in an external box. It's outside the range. So it's an external liquidity right now. So you know that this, all right, it's a weak high. It's not supposed to break structure down because this was in an impulsive move up, which took out the previous expectations of this box. Okay, so now they are doing this to get early buyers into the market, which officially takes out the previous all-time high. Okay, to make these guys feel, yeah, we're on the right side. We did the right thing. Okay, so we got and stuff like that. So what do they do next now? This shoots back down, making these guys feel, the retails saw this move already. So they saw this break of structure and they saw the clearing out of liquidity and stuff like that. So they're expecting a pullback into the zone, okay, and then something like this to create a new high. So they feel like, this move was a manipulation, yes, which it was, and then they rush back up, which means they left the 50% open, which this is pure smart money, all right? But then using the law of supply and demand and stuff like that, you understand that this range wasn't completely cleared out. So, what was the inducement in this market right now? The inducement which got buyers or retails into this market currently, this range, was because of this movement. All right, like the meaning of inducement which we saw here, a thing that persuade or lead someone into doing something. So, this movement was what lead buyers into this market. Okay, this impulsive move back up was what persuade the buyers into this market. So this becomes the inducement. Not this. This is liquidity. Okay, this was liquidity that was created for the range, but this is the inducement. This was what persuade the buyers into the market. Okay, so what you expect them to do when you say they're coming out to take out an inducement is because you're expecting them to take out this low and then finally clear out the liquidity within this range. All right, which then their intentions within this range is finally completed. So now they are free to move back up and create a new range which should look like this. Okay, so they create a new range which breaks structure and which should look like this. So they're ready to go back up right now. So now, from all this, you understand that this becomes the new low, the new important low to them, because this was the low that did the dirty work. Okay, this was the low that the money were kept. Okay, so this becomes the important low because this is the new range now. And then the high that takes out this high, which creates a new house of liquidity, which should look like this because they just cleared out the external liquidity right now. That's why they say, and you remember this was the previous external liquidity, right? Once they clear out external, they come back to clear out the entire internal liquidity, which and the inducement which was created. Okay, I can't break down every single um, idea in details for you because you have to backtest this to understand how all this work. But if you already know what's an inducement and liquidity and you understand the basic concept of structure and smart money concept, you should get a lot of explanation from all this. Okay, you should understand a lot from what I'm doing right now. So now all this was the intention to liquidate these guys and introduce new buyers into the market. Okay, so I just hope you understand that, which I don't think this could be a lot this could be broken down more than this because I just gave you everything right here. And now if you turn this around, you notice that in the process of doing this, these guys were also creating liquidity right here, which I just took out in that same process. So this was the external range liquidity which was being created. And now once the intentions over here is complete, they pay attention to these guys. Okay. And if you would notice, another block will be created within this low every single time. But before you take a trade or expect them to come below this, you want to see a break of structure from here. So you want to see them going lower, then returning back to mitigating this zone. But now, to avoid getting into a trap, you should understand that an inducement is always important in a trade. So do not get into a trade because you say liquidity right there, because all this is a process of liquidity. So all this is liquidity. They could decide to do this and liquidate everybody, or decide to do this and liquidate everybody. So what we do is that we follow the inducement that is being created below every liquidity. All right. So because we saw this persuading, which they did over here, is the only reason why we're going to take a sell from here. So the inducement should be the only reason why you're taking a trade. If you want to take a trade, let's say you want to take another block, which was from here because you saw a break of structure here, should be because you saw an inducement, something that would persuade sellers into this market, early sellers. So now your entry wants to be above the stop loss of the new order block which was formed here because that's an inducement. And then you would expect this inducement to wait the previous low because if it doesn't take out a low, then it's probably not an inducement, all right? Because it needs to wait or take out this low. Okay, so to make this look more real, like a book structure and it's going to hold. Okay, then you see something like this instead, and then they head back to take out this liquidity, which was within the previous range that was created, which took out the external liquidity. Okay, now they come back here and take this out and probably head back up to take out this high because they know a lot of stubborn traders would still leave their positions open back here. And overall, this trend is bullish. Okay, so they return back to take out the external liquidity in the same process, creating a new range. Okay, so they don't move back up in a straight line. It's going to be in a zigzag form. So, creating this back. That's why they say market doesn't move in a straight line. Not because it can't, but because it has to create liquidity along the way to take them all out, when coming back down. The only time market doesn't move in a zigzag that much is when it's liquidating. Okay, so I just explained this to you guys. This looks a lot messy right here. But if you followed up and you got confused, you could just restart, the whole video from the beginning and watch it slowly. All right. I try to make sure that I'm a bit slow because the guys have been complaining that I'm a lot fast on my videos. So I try to be slow here to help you understand this a lot. Because if you understand this concept of trading, trust me, it's a plus. Whatever concept you're actually using in the market, be it um, retail, Falcon, ICT, smart money, Wyckoff, whatever it is. If you understand this concept, it's going to be a plus for you. So I'm going to use the trade I took on Euro US GBP USD, my favorite pair actually, to explain this concept where it took place right here. Okay, let me just take that away. Okay, now first of all, I was interested in this market. I shared this setup to the Telegram channel, so I had to put some stuff on it for you guys to understand that because I know there are some people out there who already know this concept of trading. So the channel is just there to help you understand this in general. So right, so I saw this break of structure, which means once they broke this structure, this becomes the previous range, right? So if they're going to be returning back to head back up into this zone or to take out this high because it's a bullish market, they have to clear out everything within this range. So now, let's say this was the first break of structure here, right? So this was the first house, which means from this low down to this low becomes liquidity. But you could see how the mitigation happened over here, and then the momentum, which is the liquidity, crazy price action on the lower time frame, which was created there, and the imbalance. So take another block when you see an imbalance. So that's important too. And I guess you guys already know that also. So you could see clearly this cleared out this sticky price action, which means this was an FU candle. Okay, so this was an FU candle that cleared out the entire liquidity within this range. So this low to this high becomes our area of interest because this is the low that took out this high. All right. So now, once there's a break of structure, you can see there was a pullback here. Then price went back higher. Okay. So take out another high, which was this break of structure here, which is also a mitigation of a breaker block and stuff like that. So now, once all this is done, I'm not trying to teach you a concept or a strategy of trading here. I'm just trying to show you liquidity and inducement being created in the market at the same time. Okay, so now once this is done, there's a break of structure. Now you're expecting a pullback into this range, which you can see. So where is the liquidity that was created within this previous range? This low. All right, so let's use the concept of the iPhone stuff I was explaining earlier. So let's say this was the price of the iPhone, or let's say the price of GBP JPY at $100 here. So they bought GBP JPY at $100. It came back down to $100, which picked the remaining interesting early buyers. Probably the company and the smart money traders and the big guys. So this was where GBP JPY made an impact. Let's say iPhone, or let's say something you all know that made an impact like this recently. So let's say BTC. So this was when BTC started. Nobody knew if it was going to go up or low. So no one was really interested in it. Then it came back down to let's say 800 $8,000. So at $8,000, the big guys got in, which was when Elon Musk and the rest of them got into the market here and then pushed the market back up. So this rally caught the attentions of the retail traders, which is me and you. So price came back down. We traced back, which is BTC. We traced him back to $39 right here, $39,000 from after hitting $50,000. Okay, so it went back up, made wave. So this gave the retails, which are us, trust that the market is going to keep on going higher. So it's a good investment, right? So it came back lower again into this was 35, so let's say 40. And more retails got in. And price went back up and broke the previous high. So it tapped into 49 because this was 50, the previous all-time high. Okay. So they keep doing this stuff. And then they finally broke the all-time high and BTC went to $80,000, which was right here. So now with this being done, you understand that all this liquidity was built within the 39 to 40. This was the period of liquidation. They were creating liquidity. Okay, so all this right here was liquidity, not this. This is the big guys. So this is where we have to put our point of interest. This is, let's say, Elemos right here. They cannot liquidate Elemos because he's one of the big guys. All right, so he's the smart money trader right here now. So we are the retails. We are the ones the company are after. Okay, we are the ones Bitcoin is after right now. So Bitcoin returns back into the range and is looking for us. Now, what they did right here was an inducement. Okay, this was an inducement. They did this because this was the previous low, the book structure, and then this was inducing buyers into the market. So this shady price action right here was inducing new buyers into the market. So this fake movement up, which cleared out this liquidity, internal range liquidity here. Don't mind this; these are all higher time frame setup and stuff like that. And when I was watching the market, so let me just clear it all up so it doesn't cause any confusion along the way. All right, it's clear. So all these were creating liquidity. Okay, so this was inducement. This was what induced new buyers into the market. So this was the liquidity. So now, how do you know this inducement is a fake out? Because you understand that the retails are right here. So why would they create an inducement here to go back up from here without taking out the retails? So this means their intentions are not complete yet, right? They never came down to do anything. They just paid us. They just gave us another opportunity to ride Bitcoin to $100, $100,000, right? So they have to take us all out. So this was a fake inducement to induce us into the market. So the process of taking out the previous liquidity, they get to take us out as liquidity. So this is where inducement is actually liquidity. It's liquidity is a trap. Inducement is the trap that was created. So this right here was a consolidation, which you could see clearly. It's within a range. So now they took out the high of the range, which was taking out this liquidity, which was internal range liquidity. This was within this new range after a book structure here. So I took a sell from here, but I'm not talking about the setup. So I'm just trying to teach you guys a different concept. Okay. So now they took out the high of this range, which means they mitigated this supply zone, because now your attention should be looking for sales, because they're back into this range here, and they're heading for this liquidity, right? Stop looking for buys. Stop trying to counter trade this when it's on the downtrend and it hasn't grabbed any liquidity yet. So it has to grab liquidity. So this was the accumulation they did, and they went to the high when they mitigated the supply zone, and they came back down. So they did an extra inducement also, inducing buyers into the market. And then if you could use the work of distribution schema, you could say this was a buying climax, secondary test, and stuff like that. The UTAD and the last point of supply before price went back down. So this was a reaccumulation, which redistribution, which was created right here. Okay, which was also accumulating traders. All right, so they did this, and then came back down and cleared out this liquidity. So now their intentions have been completed right here, right? So now, how do you know they're going to respect Elon Musk? Because it's all a game of prediction. How do you know Elon Musk is not going to get stopped out? The inducement which was created here. Now they did this a fake movement. Now let's go to the lower time frame since we're on the coin price right now. So we know this was Elon Musk zone, right? Okay, and this was where the internal range liquidity ended. Okay, this was where all the lows within the range was completed. If you could see, I marked out every single range low, not just the liquidity. This was the fair value gap. So this was the end of the range. And so this was my point of interest right here, right? This was Elon Musk. Okay. So now with this, you understand that the first, I don't know if you guys already know this, but in every other block, there's another block at the opening and at the 50% of the other block, right? So now they tapped into the opening and went back up, making a fake bullish movement, which got everybody's attention. This was the tight range to the book structure here and book structure again. So all this was just an inducement to get new buyers into the market, early buyers to break even. So all those who enter the market here are already on break even and feel like this is already a risk-free free trade. So there was a stop hunt, and this stopped out all these guys because they have to accumulate to go back up. So this was all an accumulation happening right here. Okay, so now they did this. Now this was where it became very, very interesting, which I had to use this as an example to explain this concept. So you could do the research yourself because this is basically what I do before I look for other blocks and fair value gap and stuff like that. So that's not what I'm here to teach. I'm just here to teach you the difference between liquidity and inducement. So now, with this being said, you understand that the accumulation has been done, the stop hunt has been done. Now, what do you want to see for price to move back up? An inducement. So this broke structure, and this became the new range. So this became the new range and our point of interest, right? And you could see clearly this was another block that cleared out liquidity, right? And book structure. This is a clear order block. Everyone is saying this. But this was the 50%, okay, of Elon Musk. Let me just, I'm just trying to, all right. So this was the 50% of Elon Musk right here, right? So they took that in, and there was another block within this week, okay? So there's another block within that week. And then we could see clearly that this other block did not mitigate this, but instead came close and then went back up. Why would they come this close to the other block without mitigating it? Because now they understand that this, let's say GBP USD has been in a down movement. Now let's use it as BTC again from the beginning, from the top. This was when BTC was created, right? This was the important zone of BTC when it was at Elon Musk. So it started buying, going up, then the guys, the smart money traders, which was us, got in here, all right, which was the 50% of Elon Musk. Now they just repeated the same scenario they did at the previous spot, at this same spot again. Now they came back down and went back up to break structure. This caught the attention of new smart money traders, right? That this was another block that broke structure, and this was liquidity below it because this is liquidity. All right, so everybody's attention is going to be in here, and you could see clearly this was an accumulation schematic happening right here. So what do? You understand that they never moved into this other block, means this other block is still open, and this is an inducement. So this there's going to be a stop hunt of this low because it's an inducement. Okay, that's why you see my order being placed below this and not at this other block because now they want money to move back up. They want our money. Okay, and then you see clearly they took out the low and price never came back down before going back this higher, and this is where price currently is. And I hope and pray to God it gets to the TPF from second position because forgot all this. I'm saying this is all a game of prediction, and it could just go we right now. Okay, so that's it. That's how you understand what liquidity and inducement is. Don't get confused and then say, I'm going to buy from this other block right here because of this inducement when you don't understand what what is happening in that current range. Just note that after every break of structure, okay, there's going to be a pullback to grab liquidity within the range. Okay, so this was a break of structure. This was the pullback to grab liquidity. This was the liquidity that was created here. Okay, now they grab this liquidity, and you could see clearly there would always be a stop hunt. There would always be a stop hunt of early buyers. So you could see the return, which never got into this other block, right? There was another block within this week. They came back down, took out this liquidity, internal range liquidity here and here. This was all liquidity within this range, right? I'm showing you all this in random structures here, so you could look for it when you're on your free time or when you're studying. So once they cleared out all this liquidity, their intentions were done. So what was the remaining intention now was to go back up, right? But then you see they never moved into the other block, which was right here. And this movement persuaded the early buyer. So they would think this was a break of structure. I'd want to put the stop loss here and buy at the other block within this week. But instead, now they'll do a stop hunt into the original order block, which they were supposed to mitigate earlier. And now you see they never took out the low, just did a scary um movement just to scare, I guess, to scare guys up to manually take out their trade before moving back up. So this is just the whole concept of structure here. You have to understand structure not as the book tells you, but as a smart money trader. You have to understand and look for liquidity. Look for you. Think of what you would do and play smart. Okay, think of where you would think where you the obvious order block would be, and then I won't say put your stop loss, put your entry at this where you put your stop loss, because well, if you do that, sometimes that might work, but I'm not telling you to do that. Okay, only do that when you see an inducement. Now you see clearly this was another block, right? The book structure here. They returned back and got more buyers into the market and book structure. So this was the inducement that induced more buyers into the market. So now what did you see? They returned back and came back into the other block, the original order block here. And if you had picked this, would have been a snipe. Okay, so every single time what they do is break structure, create an inducement to make each and every one of you want to buy at this other block right here, because this was the inducement, and then you see a fake you know, movement up, and then pow, pow, pow. They mitigated the other block, and now they're moving back up. So you should always look for an inducement before you take in any trade, but only take an inducement after they're done taking out the internal range liquidity. Okay, so after they clear out liquidity, they're going to head out for the range. All right, that's after a break of structure, they head back into the range, and then they head to create an inducement, then they take out the inducement before the wave movement is formed. So I hope this video has been educative to you and you have learned something from it. And leave a comment below if you have any idea on the next video to shoot, because I might just start doing breakdowns of trade I take like this, and along the way teach what I can. But this was a video that was originally meant for my trading family, but I just decided to share that to everyone because a lot of people need to understand this concept. Okay, this concept of liquidity, and you know we are the right path. So thanks for watching. Like and subscribe, please. Like, please subscribe to our channel. Okay, let's get this channel to 1,000. Like, I'm trying right here. Okay, I'm giving this out for free. At least the least you could do is subscribe to the channel. Okay, so all right, bye.